Why interest rates skyrocketed after COVID. After COVID, interest rates rose sharply, catching many by surprise. Governments and central banks had pumped trillions into economies through stimulus payments, low interest rates, and bond-buying programs. This flood of money kept businesses afloat and consumers spending, but it also set the stage for rising prices. As economies reopened, demand surged. People who had saved money during lockdowns started spending again, while businesses struggled to meet demand due to supply chain disruptions. This imbalance pushed prices higher, leading to inflation rates not seen in decades. Central banks like the Federal Reserve and the European Central Bank had a choice: let inflation run and risk long-term economic instability, or raise interest rates to cool things down. They chose the latter. Higher interest rates make borrowing more expensive. Mortgages, car loans, and business loans all become costlier, discouraging people from taking on debt. This slows spending and investment, reducing demand and, in theory, bringing inflation down. Another reason rates had to rise was to restore credibility. Central banks had spent years keeping rates low, and letting inflation spiral out of control could damage trust in their ability to manage the economy. Raising rates signaled they were serious about tackling inflation. The impact was immediate. Stock markets wobbled as investors adjusted to a world of higher borrowing costs. Housing markets cooled as mortgage payments soared. Businesses that had relied on cheap debt struggled to stay profitable. Despite the pain, central banks believed this was necessary. They remembered the lessons of the 1970s, when inflation remained high for years because policymakers hesitated to act aggressively. By raising rates quickly, they hoped to bring inflation under control without causing a deep recession. The big question now is how long rates will stay high. If inflation falls quickly, central banks may start cutting rates again. But if price pressures remain stubborn, borrowing costs could stay elevated for years, reshaping the economy and forcing businesses and consumers to adapt to a new financial reality. Rising interest rates have already changed the way people borrow, invest, and spend. The next few years will determine whether central banks successfully tame inflation or if we're in for a longer period of economic uncertainty. What do you think? Should central banks keep rates high, or is it time to cut them again? Let me know in the comments. If you found this video useful, hit like, subscribe, and stay tuned for more insights on money, markets, and the economy.